Hey, Kookie. Welcome,
Mark,
mate.
G'day, how you going?
Oh, I'm getting brain damage. That's what I'm getting, mate. Because I'll tell
You
what,
too?
yeah, no, totally. Because, we keep hearing conflicting stories. We hear our mate Warren Hogan come out and say there's going to be rate rises. We hear the Powell in the US say things like there's no way I'm going to do rate reductions because inflation's a little bit too so-called sticky. Then we get the Fair Work Commission coming out and giving us a 3.75% increase for about 2 million Australians.
Yeah, minimum wage and everyone who's on
I think there's about 2 million people.
About 2 point something million. Yep.
And then 1 July, we're going to get a tax reduction. I know it's not a huge amount, but it is something. It's overall, it's a lot of money. That whole amount of money is going to go back into the economy.
It is.
But then we see numbers that we're going to talk about in a moment, but we see not such great indicators in terms of GDP, unemployment, etc. So I'm getting brain damage, mate. And so what you're here to do is fix my brain damage. So today you're not an economist, you're a neurologist, okay?
I'll do my best, mate. I'll do my best.
So it is neurotherapy for me, mate. So, okay. Since we last met, it'd be fair to say you and I are meeting. We always meet prior to the next RBA meeting, which is on the 18th. So we're here to try and decipher what move we think the RBA will make one way or the other. What are the indicators that the RBA will be looking at? Because the RBA doesn't really know whether inflation is going to stop. They don't know when to increase their rates. They just look at data on a certain day. So what data are they looking at? I know we're going to go through our board in a minute, but what are they looking at? What's relevant and up to date now?
The high profile issues for them for their meeting next week, next Tuesday.
Yep.
They, like you, I think their brain's a bit scrambled as well, to be honest. And that's not a criticism because, as you pointed out, we're getting really weak GDP numbers. So that would be something that would give them some concern.
What does that mean?
The output of the economy, so the amount of production, gross domestic product, including the amount that you and I spend in the shops, that businesses invest in building buildings, buying machinery, that the government spends on healthcare and education and road building. The whole of the economy, anything you see out your window is GDP, and a lot of services too, insurance and the like. It only grew by 0.1% in the March quarter. That is really pathetically weak. And the RBA would be looking at that, and if that was the only indicator they had, and of course we're going to talk about a whole lot more, they'd be really worried. They'd be probably cutting interest rates because output in the economy is way below what it should be. We know from history that the Australian economy, when it's in this so-called equilibrium, so that Goldilocks, not too hot, not too cold, should be growing at about 0.7, 0.8 per quarter, 3% give or take per annum. So 0.7, so the last 3 quarters, it's not just that last quarter that is causing concern. The previous quarter was only 0.3, the quarter for that was 0.2. So we've had 3 quarters summing up to 0.6. We should be growing by at least that every single quarter. So that's the thing that's the RBA is thinking, oh, gee, that's a bit of a problem.
Well, can I just stop there for one second, Steve?
Yeah.
Tell me this. When the Treasurer, who we love, gets the Department of Treasury, don't laugh, that's not very nice.
I'm just smiling.
Gets the Department of Treasury sitting under Kennedy to build a budget for him to talk about.
Yeah.
It's a budget. So like you and I budget, my business budgets,
of course,
we make some assumptions.
We do.
And we make an assumption about growth because we got to say how much will the Australian economy grow this year, which will determine how much taxes we think we're going to get in because that's our revenue.
Yep.
And therefore that will determine how much we can spend. So we can either have a surplus or a deficit.
Correct.
Okay? Right. So, and I've never seen a budget yet in my life that's correct. That's turned to be right. Never once.
No, they're always within. They don't even hit the dartboard, let alone the bullseye. Yep.
So one of the assumptions they make, I presume, is inflation. Is
economic growth.
Is growth, GDP.
Yeah.
Because if it's 2 trillion this year, we grow up by 3%. So what is the assumption that the Treasury makes in terms of what they think GDP growth would look like? What is it generally speaking?
It is generally that somewhere when things are okay, not too hot, not too cold, about 2.7 to 3%. give or take. It depends.
That's my memory.
It depends a little bit on population growth. It depends a little bit on productivity, which I know we're going to talk about in a little while. It depends a little bit on just what's happening in the global economy. But let's call it 3%, and
Okay.
that's what, if you could be the Treasurer and the Reserve Bank Governor and wave a Harry Potter magic wand and say, I want 3% GDP growth per annum, constant for the next 5 years, that's what they would say. Wouldn't be 4, it wouldn't be 2, it'd be 3.
So if it doesn't grow at 3%,
Yeah.
so let's say they made the assumption of 3, but it grows at 0.1%.
Yes.
Or let's be really generous, 0.6%.
Yeah.
What is the economic effect of that in relation to the budget? And does it, in terms of surpluses and deficits?
It means that the economy is producing fewer goods and services than was assumed or forecast at budget time. It means that as people spend less, by definition, they're paying less GST. So instead of spending $100, I'm going to spend 95, they're collecting less GST, for example. The shopkeeper who's getting fewer people through the front door says, oh, gee, I better not, I'm going to sack one of my staff because I just don't have the business. And the trucking company.
So unemployment increases.
And unemployment goes up. So you get less PAYG tax, pay-as-you-go tax, income tax.
So they collect less revenue.
And the company profits fall because, oh, gee, no one's coming into my business. So my profits have gone down.
So they pay less tax.
So therefore, it's pretty simple. What's the bottom line? The budget slips into deficit. And if it's really bad, it's a really big deficit, correct.
Right. And in terms of further GDP recovery, let's say we got 2.1, we never know, but 2.1 million small businesses are here in Australia, which employs 70% of the population.
Correct.
That's a fairly important component because if they're not feeling confident, and we will look later at business confidence, but if they're not feeling confident, then business investment will be lower.
Will be lower, yeah.
And what does that do to GDP?
And again, that's another negative because if you're a business person, small, medium, or large for that matter, but small, as you said, small, medium businesses are the real engine of the Australian economy. If you're sort of sitting there and you think, oh, gee, the business has turned down, I was going to hire another person, I was thinking about moving to bigger premises, I was thinking about buying a new truck for my deliveries, actually, I'll hold off doing all of that because I'm seeing in my forward orders, I'm seeing it in the cash flow of the day-to-day operations of the business. It's slowed down. I'm not going to do that. So that's feeding on that weaker economy too. It's that sort of, it's why economies never grow at 3% per year. They're either growing at 4.5 or 1, there's that, or less. You've got that volatility because you can't pinpoint that as a policymaker, the Reserve Bank, or in Treasury, when you're framing your budget, government, you can't pinpoint it exactly to hit that target because something else comes in and whacks you on the head, so to speak. So you've got this situation where right now, as we keep getting the updated data on retail sales, building approvals, GDP, it's all weak. I can't think of one strong indicator in the economy, and that makes me a bit nervous.
Me too. It makes me very nervous. Yeah. So we started on GDP, and it's not very healthy.
No,
I mean, of course.
Oh, and if I can just butt in there for a second, so the last 3 quarters, those numbers that we mentioned, just sorry to butt in.
That's okay.
But the other than during the pandemic, of course, which is when we had a couple of big -7 GDPs because everyone was sitting at home, whatever. This is the worst run of GDP numbers since the early 1990s recession.
I know,
30 years ago. I think that's when we started hanging out together.
1991.
92, that was the recession we had to have when Treasurer was Paul Keating back. That's how long it is. That's how bad things are. And as I said, that's old history. The current history is as bad, if not worse. So anyway.
Yeah, no, I agree with you. So, and that actually makes me quite nervous because, as you know, we did have a recession.
Yeah, it's bloody horrible.
And I guess whilst, everyone now talks about this, we can't move off this GDP piece until we just tackle the population growth relative to GDP. I mean, we have a per capita
recession.
Yeah.
We've got without the population growth, we've had 5, not 2, but 5 consecutive quarters where GDP per person is going backwards. Again, that hasn't happened since the early 1990s.
And one more thing that's important, because people say, well, what the fuck does it matter, GDP? Well, one measure of the standard of living is GDP. So, at the end of the day, if this country is not growing by at the rate that we like to assume, then you would expect that can be an indicator of the fact that someone's saying, well, you know what? I earn $1,000 a week. I have to pay now $700 a week in rent, or my mortgage has gone up to $700 a week. After I pay some tax, I've got like $100 left. I used to buy my kids footy gear, and I used to be able to buy a sausage at the footy game, and I used to be able to take my kids to Luna Park once a month and maybe have a holiday at Ballina or whatever. I can't do that anymore because I don't have enough money left in my pocket. So therefore my standard of living is reduced. And no one wants to be measured as a reduction in the standard of living. So where do you think the standard of living is going today relative to, say, any form of measurement?
Yeah, it's flat to down. There's no question. It's always hard to pinpoint these numbers, but I don't think there's any doubt that the direction is lower. And you're quite right. And in 1 year, it's very hard to measure a fall in standard of living. It might mean people have mincemeat and spaghetti bolognese rather than fillet steak, or they have a holiday at Bateman's Bay rather than Bali. So they're still okay, but it's just that change in what people do and what they spend their money on, so to speak, or they buy a second-hand car, not a new car. So look, things are not catastrophic, but it's not good. Where you do get is looking over a slightly longer time. And go back 20 years. In the last 20 years, aside from this last little blip down in per capita GDP, per capita GDP has risen by about 20%, and that means that people are 20% better off. We have more access to healthcare. We're living longer. The quality of housing, and we talk about house prices a lot. The houses that we are living in are better quality. They've got air conditioning. They've got fancy ovens. They're nice compared to the funny old houses in the olden days, so to speak. So that's how you get the improvement in living standards. So it's not just essentials like healthcare and those sorts of things, but it is luxury goods like having a snazzy car and going on a holiday and those sort of things. So the fact that it's starting to tilt down is eroding living standards. There's no question about it.
And so part of the discussion around GDP and inflation too, by the way, because a lot of people say, well, why, what's like inflation of 3.6%? Is it so bad? Like, why have we got to get down to between 2 and 3? GDP, what relevance has that got to do with anything? And one of the ways I try to explain is that it is these things are measurements of standard of living, and a government's job is governing, and part of the governing is to try and manage our standard of living,
improving it at every opportunity
for everybody.
Yep,
and not just for
lifting up the poorest in society, but allowing, this is a bit sort of from my soapbox here, but allowing the successful people to be successful. That's great. That's what makes an economy dynamic. Risk takers and all the rest of it. But you also have what's been termed over many years the safety net. So people who slip through the safety net, we're a good bloody country. Look after them if you're unemployed or if you've got a disability or something. We can afford to pay a little bit of tax to make sure those people are looked after, but letting the rest of it go and grow, because I think that's the important part.
So there is another measurement which governments never talk about, and I haven't talked about it for a long time. Hopefully you remember how this works, but there has become a much bigger chasm between those who are doing really well and those doing really poorly. Now, we used to call that the Gini coefficient.
Gini coefficient, G-I-N-I, if anyone wants to Google it.
G-I-N-I coefficient. Yeah. Now, that's a mathematical formula to look at the gap between, just for ease, rich and poor. It's probably not quite that.
It effectively is, yes.
So, yes. And that gap's got bigger.
And it has, yes.
In Australia.
There's been a deterioration.
And that has to be something that I would have thought governments have got to be talking about, I just think. I think. And inflation is a really big component of that gap, because if you're earning, the example I gave before, you're in the lower coefficient and you're earning $1,000 a week and you've got all these costs, and you're getting poorer, yet you're someone else in the rich coefficient. It doesn't matter to them if steak now costs $55 a kilo instead of $45 a kilo, because the amount of revenue they're earning is relative to the cost increase is nothing. Yeah. And if I was to try to explain to people why inflation is an important thing to control, I think it's better off put into these terms about the difference between living rich and living poor. I think a standard of living is important too. Like, just the standard of living seems to be more importantly sit in the middle for the middle Australia. Yeah. And the Gini coefficient's better in relation to the two ends of the coefficient. So I just think that's an important thing to give our listeners some perspective as to what's important, because you get the Reserve Bank, inflation is really bad. Well, why is it really bad? Tell me why it's really bad. She's never really explained it. No one actually tells us why it's bad. We know cost of living hurts us, but tell us in real terms. It's about maintaining our lifestyle as Australians. We don't want to slip into something like Argentina or something.
No, and in fact, going back to the early 1990s again. Remember when, and that recession that we had to have broke the inflation stick. Before then, we had inflation at 10 and 20% for I don't know, 20 years or so. And that's when the 2 to 3% target came in about
96.
Yeah, 94. Bernie Fraser mentioned it, but Peter Costello, when he was Treasurer, legislated it, effectively legislated it. So
it was sort of mandated.
And the governor at the time, I think it was Ian McFarlane, if I remember correctly, he said, we're going to keep inflation between 2 and 3%. So, and back then the explanation was that if we've got high inflation, and if you're on a fixed income would be your pension or your super or just a wage where you're not getting big wage increases, you're just getting a couple of % per year.
Like the Fair Work Commission style.
Yeah. And the basket of stuff that are the essentials, your loaf of bread, your carton of milk, the petrol you fill up your car, your insurance comes in. If they're going up by more than your wage increase, you're going backwards. It's obvious in a sense. And
you have to give up. You have to give up on something else.
You have to give up on something else. You have to cut, and that's really bad. And that's why low inflation and having that inflation target is so important.
Right. So
because it is unfair,
because I think
it does hurt people when there's high inflation. Yeah.
And I have thought it's important to give people a bit of perspective on this, because as opposed to just throwing economic jargon out there, which we're about to do. But just quickly, in terms of other things that have happened. So the Fair Work Commission came out recently. They gave 2 million people, as we said earlier, or 2+ million people, a 3.75% increase in wages, which I think it comes into effect later this year.
It takes effect on 1st of July.
1st of July,
Same day as those income tax cuts, by the way. So some people are going to be pretty happy in July.
One of the things that the Fair Work Commission took into account, and this is a complex thing, if you could quickly explain it, is the role of productivity in Australia.
Yes. Just looking back, the previous 2 years of the Fair Work, they meet every year to increase the minimum wage.
Yep.
2 years ago, it was 5.2%. Then it was 5.8%, and this is only 3.75%. So it's lower than those earlier years.
And the unions were asking for 5%.
Yes.
And they didn't
Correct,
get it.
They didn't get it. And one of the reasons is the productivity in Australia is still pretty crook. We're not, and productivity is producing more output with the same amount of inputs or with fewer inputs.
In other words, if Steve works for me and he works 40 hours and I'm going to give him an increase in wages, I want Steve to give me more product.
Yes.
So that I can sell more product.
And that could be via better machinery, so I can have a better computer to do my work more efficiently. It might be sending me off to training, so I don't sit there with a pen and paper and do things that I can learn to type.
Might mean you come in the office 5 days a week.
Yeah, it can mean a whole lot of things. So productivity's sort of when you explain it like. One example I like to use is sort of in the mining sector. You give 10 people a shovel and a wheelbarrow, go and dig out some iron ore. You're not going to get a lot of iron ore, are you? You give 10 people a truck and a digging machine, you're going to produce tons. Still only employing 10 people, but your output of iron ore has gone up massively. So that's why productivity, even in services for nurses, teachers, bankers, retailers, is important. And a lot of it's to do with technology. So think about nowadays how few bank branches there are, for example, because we don't go into the bank branch. I pull out some cash and write some checks. God, what are checks? Anyone remember? And send them in the post. So Australia Post is doing really badly because no one's posting letters anymore. We're all clicking, emailing, paying bills online, automatic direct debit. So that investment in that technology has been something that's helped productivity. It's been a really good part of productivity. But on the other side, we've got this, it's hard to explain why we just don't have that more output per person. I think that because until recently, wages had been relatively low until recently. A lot of businesses said, I'm going to employ more people rather than invest a whole lot of money in machinery and equipment. So we had weakness in business investment. We had the employment market looking pretty good. That's now starting to change. That might be one of the benefits of this weak period of economic growth with business investment picking up a little bit and the unemployment rate picking up, unfortunately. But it might actually mean we're getting some productivity at long last.
So, but we haven't had it yet.
We haven't had it yet, no. This is sort of like, I won't call it pie in the sky, but it's an optimistic take on where we might be over the next year or two.
And what the RBA is worried about, though,
Yep.
is that if I give you a pay rise
Yep.
and I don't get more productivity,
Yep.
and your employer will say, this is costing me more for this, more money as your wages
pay
being one
rise,
of the
yep.
inputs to produce the same widget,
Yep.
which I'm going to sell to the consumer, and I can't. So I want to make the same margin. I've got to make a margin. I want to maintain my margin. So the only way I can maintain my margin is put my price up.
Correct. And that's where that's
inflationary.
That's the old-fashioned wage price spiral. That the only way you can maintain your margin is bumping up your price. And so the consumers who see their prices going up go to the Fair Work Commission and say, I need a bigger pay rise because my cost of living's gone up. So you get this circular upswing.
Where is the pay? Where is this wage spiraling position right now?
I think it's falling. It's not happening.
Good.
So the good news, so we've sort of built up what do we call it, a straw man or straw person. We've just about to shoot it down because a couple of things are happening. This slowdown in the economy and the influx of people through this high immigration that we hear in the media.
So more people to come and get jobs?
Yeah, it tends to be focused on, they demand housing, which is true, but they also supply their labour. They want a job, they want to work. So that a lot of the labour shortages that were leading to a bit of a pickup in wages a year or two ago are starting to come back. And in fact, when we look at the wage price data, which again came out 2 or 3 weeks ago now, it was lower than the market thought. It was only 0.8 for the quarter. The previous, like GDP in a sense, it's gone 1.2, 1, and then 0.8. So we've got this slowing coming through in the quarterly wages data because more people are coming in, and that slowdown in the economy is seeing the unemployment rate tick up. So if unemployment rate's ticking up, it's harder to go to your boss and say, hey, mate, I want a nice big pay rise. Because look, the labour market's slack. You can leave and I'll hire someone else, to be brutally harsh about it, because that's sort of how it works.
Okay, so that takes us to your board. Let's go through it, because these are quite complex and deep things that people need to understand, because the RBA governor, she's got to make a decision, or the board's got to make a decision along with her as to what the data tells them. And I think it's important just to go through those
and what
those
the data tells
notes.
them and why it matters. Why does that inflation number matter to them more at the moment than the GDP numbers?
So at Yellow Brick Road Home Loans, we want to do our bit to make a difference and tackle this housing crisis head on. That's why we're putting out a call out to all Australians to join us in helping their mates, whether they're thinking of getting into the property market or just want answers on their own current mortgage. So refer a friend or a family member who could benefit from a closer look at their home loan options to speak to an expert Yellow Brick Road mortgage broker, and you'll both gain an entry to our $40,000 Help a Mate giveaway. At the end of this campaign, my team and I are going to randomly draw out one of two $20,000 prizes split evenly. That's $10,000 each for the winning referrer and their mate. But if you want to enter by yourself to help out with whatever you like, whether that's your bills, first home deposit, or your mortgage repayments, we've always been here to guide you down the road to home ownership. And now we want to extend that guiding hand to your mates. To enter this giveaway, head to ybr.com.au/mates. Let's spread the word and help our family and mates achieve their dreams of home ownership. Head to ybr.com.au/mates and share yours or your mate's story to both go into the running. And good luck with that.
All right, Koukie, we've got the board here. And
Yes, Mark.
What's interesting about this board, I'll have to be honest with you. I mean, I've been following your little matrices for like, I don't know, a million years now. When it goes back to the 90s. But this one's quite a lot, okay? But for me, the top ones, the four horsemen are at the top.
Correct.
Probably not in order of importance, by the way.
At the top end of the things that are really important. The things lower down our board here are not unimportant, but
they're indicators.
They're not going to be the driver that forces the RBA to move. These top ones are the real punching ones. They're the ones that really, really impact the RBA.
And tell me, of the top four, could you just tell me one thing? how would you rearrange in order of importance?
Might do this next time we get together. I think inflation and labour market are the top two.
Good point. That's what I forgot about asking before. How come labour market has now become elevated? The Deputy Reserve Bank Governor we recently had an interview and he did talk about labour, the importance of unemployment. No, the importance of full employment, which no one knows what that means. So therefore we look at unemployment. But talk me through that because it's a new phenomenon.
A couple of things. One, as we've spoken about in the past, Treasurer Jim Chalmers had a review of the RBA
last year,
implemented changes. They're still coming into being. They've got to pass Parliament, by the way, so that's why there's this delay, which is a little bit frustrating. But nonetheless, the changes there, and the critical one when Michelle Bullock was appointed governor back in September last year, was for her and the board, the Reserve Bank board, to give greater emphasis to unemployment when it came to setting full employment. Yes, correct. Sorry. When they consider interest rates. So yes, the 2 to 3% inflation target's still there. That's
primary.
That's primary. But if it's at 2.9 and unemployment's going up, even though it's not the middle of the target, they'd cut rates. Because look, we can tolerate an inflation rate at the upper end of the band. If unemployment's going up, we don't want that to happen. So the labour market indicators, so things like unemployment rate, job vacancies, wages, which is sort of part of the labour market, they're the critical things that the new deputy governor also mentioned when he gave that talk.
So would you say then, in terms of data analysis before each board meeting, that the unemployment number and also the seek job advertising and job vacancies, etc., and participation rates and underemployment numbers, underemployment numbers, I said that right? Underemployment numbers are going to become far more critical. The
short answer is yes, they are. They were always important, but I think they've even got an extra.
Are markets? I don't know if they wait. I don't know, but I'm just wondering: have markets reweighted their analysis?
No,
I don't see it.
I don't think they have because the labour market conditions right now are problematic.
I think they're average at best.
I think they're deteriorating.
They're average at best.
Mark, as you said, the Seek job ads, the ABS, Bureau of Statistics job vacancies, they're all going down. Demand for labour is falling.
Underemployment is going up.
Underemployment and unemployment it's gone up 0.6 of a percentage point in a year. That's pretty chunky. In terms of people, that's about 100,000 people. Think about that. 100,000 people are unemployed today that weren't unemployed a year ago.
So if you and I are sitting here talking to Warren Hogan, who's very
hawkish.
Hawkish is the word. Would we be a bit more dovish and sort of say, hey, Warren, mate, the unemployment, have you taken this into account?
I've had this conversation with him, and Warren's got a lot of profile this last couple of months with his rate hike calls, and he's got I really enjoy reading it. I happen to disagree, sensible people can disagree on a topic, that's fine. But when he writes about it...
I asked him to come in with us, by the way. I asked him to come on, and he said, no, I'll come with you, Mark. I won't come with you and cook you together, because he thinks we're going to bash him up.
Come on, mate. I'm not going to bash you up, mate.
No, but he thinks we're going to join forces. But
anyway, we'll come next month because we'll still be having this debate, I know.
Yeah.
But the critical thing here is there's not a lot of discussion of unemployment, of the people who are, we've got to kill inflation. Fine. They in their articles they write, they very seldom mention the labour market, the unemployment rate, the wages side of the economy, which, as we've just discussed, is a higher importance,
much more weight
for the Reserve Bank than it was a couple of years ago.
Much more weight.
No question. Absolutely no question.
And I will just say one more thing, which is boring, but the non-accelerating inflation rate of unemployment, NAIRU, she talked about 4.5 in July last year.
Yes. She
has not reviewed it. Has she reviewed it? I need to know.
There was the short answer is I think they have.
No, I haven't seen that published. It hasn't been published.
Last week, Michelle Bullock and one of the assistant governors, I was going to say Clark Kent, not Clark Kent, can't remember his first name, Mr. Kent, were appearing before the Senate. And one of the senators was asking, how's the economy? NAIRU, I think they let slip it was 4.3.
No, hang on. They can't go and do this. They can't do a review of what they've already published without publishing it again. Surely.
They mentioned it in passing, and I was shocked that it didn't make headline news or that she wasn't followed up with more questions on the 4.3.
That's because no one understands this unemployment thing, mate. That's my point.
When they put out their forecasts in early May, they've got unemployment and coincidentally peaking at 4.3. They've revised that down from 4.5.
Well, then we should somehow press this. But if it's 4.3, we're very close.
We're very close. And in fact, we'll start on that if you want.
Yeah, let's start on it.
Because unemployment rate's 4.1.
Yeah, I know. So I'm saying.
And the leading indicator. So 4.1, you might think, that's not bad. And it's not bad. Look, we remember 10% unemployment. That was absolutely horrible.
Well, during COVID, it got to 10.
We want full employment. I love Australia. I love our economy. I want it to be a good economy, not a basket case. So I'm going to put the labour market not quite fully in the easing category yet, but close to it. If we get another 2 months.
If 4.3 is right.
Yes.
Like if she could confirm that, somehow they could confirm 4.3 is the number that they think is inflation is not accelerating at.
Yes.
Or won't accelerate at. That's important.
And I think it's true too, by the way, because just by the way, even though unemployment's only at 4.1 and it's gone up, wages growth is already slowing. Inflation's already coming off the boil. So if you looked at what do we call empirical evidence, the data flow, unemployment's gone from 3.6 to 4.1. Wages have gone from 1.2 per quarter to 0.8. Sort of rattle all these numbers off. And the unemployment rate's gone up and it will keep going up. No question, it'll keep going up. So maybe the NAIRU is 4. Could be. And that's
revised.
We'll find out in hindsight. It's one of those things you don't find out until you've done it, sort of thing. If that is the case, then it's all bets off for interest rates because they'll come down. I said I'm not going to put my hand on my heart and make that forecast now, but it is something I'm watching extremely closely.
After the 18th, on the 8th, when she does that 1 hour
the press conference,
I really hope she addresses this.
I'll have a chat to a couple of my mates who go to those press conferences and say, look, just
press
ask
it.
About
press it a bit. Because
watch this space on the 18th.
Her paper was published in August last year.
Yes.
And it was 4.5.
Yeah, 4.5 was the number.
It's just modelling, but doesn't matter. It was published at 4.5.
But Mark, those models feed into their decisions on interest
rates.
That's my point. Affect you and me.
That's my point.
It might be a bit airy-fairy in terms of how they calculate it with all these economic models and regressions and all this other stuff. But if it does feed into the interest rate that you pay and I pay and everybody out there pays on their mortgage,
then we should know about it.
Loan, it matters. Yeah.
Right, let's go.
So I've got the labour market on that side. Similarly with wages, I've got them at neutral at the moment. So wages are sort of in the groove at around about 4%. On GDP growth, you'd cut interest rates. We've got a really weak economy. On inflation, I'm keeping that in the neutral to tighter because it's still 3.6. It's still away from the target. And this board, remember, is about actual data, not forecasts.
Yep.
It's what we actually know. So you can sort of see easing, slight tightening, slight easing, and neutral.
Brain damage.
That's why rates are on hold.
Brain damage. That's not talk. That's how I started off.
It is. Oh, so I haven't fixed you. Apologies, Mark. On the international, because don't forget, we're part of the global economy. I'm putting that erring on easing.
Yeah, but mate, you okay? Can I just say, our friends on the continent are all dropping rates, but not all. But America is not seeing it.
Well, America, look,
North America is not seeing it.
I'll start with my bias. Canada cutting rates, European Central Bank cutting rates, Sweden, Switzerland, okay?
The biggest economy in the world, but what are they doing?
US is on hold, but they've got this position where there's a presidential election in, 5 months, getting very close now, early November. Biden administration has been spending money like it's going out of fashion. They call it the Inflation Reduction Act or something, but their budget deficit is still 5% of GDP. Our budget deficit that came out the other day, we had 2 surpluses, now we've got a deficit of 1% of GDP. And they've not had any surpluses. So if you look at the composition of their economy, government stimulus is unbelievable. So that's why the US Federal Reserve, when they look at their numbers, think, we're going to have a slowdown, and it hasn't happened. One of the reasons
Government
is
spending.
because government spending. And, maybe our budget should have been a bit tighter or whatever, but it was nowhere near. It was a million miles away from what the Americans are doing. But yeah, you've got New Zealand about to cut interest rates too. Bank of England, okay, they've got an election too in a few weeks' time. Not that it affects the Bank of England, but inflation's falling in the UK. Unemployment's going up. The Bank of England's going to be cutting interest rates. So you've got this scenario.
ECB, what are the European?
European, they've cut 25,
Yep.
and then Christine Lagarde, the governor of the European Central Bank, she sort of hasn't been committed to the next move, but
But at least it's cut.
you don't have. It's very rare you just have one cut and nothing else. There's going to be another one sooner or later. So you've got Europeans cutting, Canadians, Kiwis about to cut. You got the English about to cut. America certainly not hiking,
but it's been propped up.
not hiking, but they've got a slightly different scenario. It'd be really rare for Australia not to be part of that. We're on the way up. The month and the magnitudes are all different, of course they were, but it's the direction that matters. So, and the timing. When's our rate cut coming? But
Okay.
the international economy, and it is weaker. Well, China, even though they don't have a financial markets like Aussie and American financial markets, they've actually been cutting interest rates too. Their economy's pretty
Well,
poor.
because that of course affects our GDP because
Correct.
that's 70% of our exports go there.
Correct. So we've got this, and if we looked at this, say 4 or 5 months ago, there are a few more of these beads
Yep.
over on this side, so they're moving that way. House prices, they're not going to cut. They're going up, and in fact, they've re-accelerated a bit. And if you look at Perth, Brisbane, Adelaide, my goodness, they're going gangbusters.
So how do
still.
but how do house prices, increasing house prices, affect, say, inflation?
Yeah, it's not necessarily, the RBA does not target house prices.
Or any asset class for that matter?
No, or stock market prices. Anything like that. They feed into it's largely through a wealth effect.
Yeah.
So if you bought your house for, I'll use round numbers, for $1 million, goes up to 1.1, goes up to 1.2, goes up to 1.5,
You feel rich.
and your mortgage, just say it was 500,000 again, just using that, has come down to 400,000. All of a sudden, your equity in that house has gone up massively. You feel rich. You can approach your friendly mortgage provider and say, "Mate, I'd like that kitchen's a bit crappy. I need to sort of renovate the kitchen, the bathroom. Yeah, here's another $100,000 on your mortgage," and the lender would be very happy to do it.
It's potentially inflationary.
So that feeds into spending. So high house prices in and of themselves are not the reason they hike. If it's sustained for any period of time and we all feel wealthy, or homeowners feel wealthy, I should qualify that very dramatically, then it does actually have a positive effect. And the Reserve Bank has actually done some fantastic research on this, which I've spent too much time reading. But when house prices go up 10% and stay there, so the 10% shift up in house prices, with a 1 year lag, because it takes people a little while to realise my house has gone up in value, it increases household spending over and above what it would normally be by 0.7%. Now, that might not sound a whole lot, but if household spending is 3% a year and it goes up by 3.7, that is
It's double.
big bickies. It's big bucks. Yeah. So
Right.
that's how it matters. Retail sales. Oh, dear. If we had
that's off the board.
That's even off the board. Speaking to any retailers, Mark, I've had a few, what do we call it? Frank discussions with a few mates in retailing. Shocking. Worst in a long time. Consumer sentiment, same thing. We consumers were feeling glum. Cost of living, interest rates, rent. God, it's pretty crook. Building approvals. I wish the government luck building 1.2 million houses over the next 5 years, because they're currently running, because that's an annual rate of 240,000 per year, they're currently running at about 160. So they're running a third, 35% less than they need
That
to.
has a converse effect
And
too, Bo.
That's negative for GDP, because if you're a builder or a supplier of materials, timber, windows, wire, and you're working in the building industry, business is drying up rapidly.
That has a slightly converse effect too, around the other way, because it can mean that there's not enough housing for the number of people.
It feeds back into house prices.
Goes
Yes,
back
the
to
shortage of
rents.
housing, correct. And that's why there's such a debate and a dilemma about what on earth do we do to get the number of houses up, the supply of housing. Business investment, it's okay. As we were saying before, businesses are starting to ramp up a bit of CapEx. We're building warehouses, machinery and equipment, AI. I don't fully understand artificial intelligence, but people are spending a lot of money on it. That's good because it employs people and it's part of the economy. That's actually doing okay. It's doing well.
And we get business investment, business confidence.
Business confidence is a bit weaker. We just had numbers out that were a little bit weaker. So businesses are doing okay. Oh, look, I put it in the middle. Businesses are okay.
Yeah, we've got, one of the things about business confidence and business investment where it's important is that a large degree of reinvesting in your business has been around me getting greater productivity.
Yes.
Because my inputs and costs have gone up and I need to get more product out in order to make the same amount of money I was making before.
Correct.
And so artificial intelligence, for example, is a way that I might be able to sack a few people.
Indeed. You can get a machine to do stuff. You have 2 or 3 people running the machines instead of 10 people doing the work, sort of thing. Again, one of my favourite ones I like to use, and remember the Harbour Bridge, driving over there, 20 cents, and they'd have the poor person putting their hand out, 20 cents, 50 cents, whatever it went up to. Yeah, that employed a lot of people. 24 hours a day, 7 days a week, and then someone had to count the bloody coins and all this.
Oh, then you had to collect it.
Collect it, count it, all that other stuff. Now, with the beep, how efficient... There'd be someone who made the beeping machine, the tag, but how efficient's that? So that's more output, and there's more cars go across the bridge today than they did 20 years ago through the tunnel. How efficient's that? That's more output for fewer workers.
Fewer jobs.
Good for productivity. Commodity cycle, neutral. It had a bit of a blip up. It's gone a bit back down. Copper and oil went up a bit because of Middle East conflict and artificial intelligence, all the chips that are being made. They use lots of metals and things, but that's just come off the ball. So it's neither here nor there. And for some of Australia's commodity prices, things like iron ore, they have come off a bit. They've come off $10-20 a tonne. So just in the neutral. Stock market's strong. Not that you'd hike interest rates because of the stock market, but it's giving a wealth effect again, a little bit like the house price series. And the current interest rates, they're restrictive. I'm moving that to the edge of we should, other things being equal, be thinking about a rate cut, but we're not yet because of that one and possibly, which is the inflation rate and probably
okay.
The labour
Which
market.
tokens do you need to move, and which direction you need to move them to get a rate cut?
This
and
one,
how far do you want to move it?
Has to move to there, which probably means we need another quarter or two of 0.6, 0.7 inflation rate. Because when you look at the mathematics of a 0.6 or 0.7, so 0.6 times 4 to get an annual rate is 2.5%. 0.7 times 4 is 2.8. So if we start getting 0.6s and 0.7s on your inflation rate, the RBA is going to say, oh, look, we've got a 2-point-something annual inflation rate. Just by the way, one other thing, Mark, which is a sleight of hand, that electricity subsidy rebate that the Treasurer announced in the budget, and it's happening in Queensland too, I believe.
No, by a much greater amount.
By even a big amount. So some states are doing it.
It's a grant in Queensland. It's $1,000.
It's $1,000. And the rental assistance mechanically feed into the inflation numbers. Yep. So they take effect on the 1st of July.
But they're fictional from my point of view. But anyway.
But they will lower headline inflation.
Yep, they will.
I said it's a sort
of
fictional. P and thimble trick.
I don't like it, but anyway.
But the measured consumer price index for the September
takes
quarter
that into account.
Will probably be almost zero. And that's why the Reserve Bank is saying, hey, we've got to look at trimmed mean, we've got to look at underlying inflation, because that's a little bit like when bananas went up because of the cyclone in Queensland, and lettuce went to $10 because of the floods in Lismore. So this is the one that has to move. Inflation. I think the labour market's almost there. So we're going to be getting worse unemployment numbers.
So we don't need to move any of the other tokens. You think?
Not really.
Yeah, if they consider neutral with GDP in the easing column.
Yep.
You feel sort of fairly confident. So where are the money markets now?
Money markets have got no change for the remainder of 2024. So the next, 6-7 months, there's no change at all built into the market. Oh, a basis point or two. There's a little bit of volatility, but effectively none.
What are the banks saying, the majors?
ANZ recently came out and said no cuts in 2024. They've got it pushed back into 2025.
Yep.
The other banks have still got a cut in November.
I think CBA is pretty aggressive.
But with caution. They've come out and said, look, this is our core view. We want to see the next inflation reading, which comes out at the end of July, the quarterly number, which is more important than the monthly number.
And the annual number too.
Correct. They want to see that to see where it's heading, and they want to see the unemployment numbers. But for the here and now, the major banks are sort of saying no moves until very late this year, if not next year. 18th of June, oh gosh, never say never in this world, but they're not going to change. They're going to hold rates steady, and it's what the RBA governor, what Michelle Bullock will say about those GDP numbers, what she says about inflation, what she says about that Nehru and unemployment.
Yep.
And if I can get one of my mates in the media to ask her a question, what is Nehru? Is it 4.3? And what's the risk that we overshoot, so get a higher number in unemployment?
What's the risk? Guaranteed.
Well, that's what I'd say.
So guaranteed.
So therefore,
they never land on the number they expect.
Never, no. And so that's why I think that would be a question that would be open the door for a return to the discussion about, well, maybe there will be cuts. But there's so many moving parts, as you can tell from this. And we just need to see the data. Mere mortals. We just need to see what's happening in the economy.
One final question to you. Do you think that it looks like hold, no rate cuts sometime to 2025? But do you think there's a chance? Because, you and I have seen this many times over. They say nothing's going to happen. We're not going to put rates up. And all of a sudden, next thing you know, they're putting rates up at a massive clip,
yes.
Effectively.
Like in 2022.
Yeah, correct.
Hikes till 2024.
They say we only had 13 rate reductions, 13 rate rises, but they actually had 18 or 17.
A couple of them were 50s.
Because they had 50s, a whole lot of 50s.
Early on,
so they forget about that. So effectively it was like 17 or 18 rate rises in an 18-month period. Like that's...
17 it was.
What the hell? Like that's ridiculous. That's crazy.
And it came out of... Nowhere. 6 months before the first of 17 rate hikes, the RBA was saying, "Oh, no hikes, no. We're
so do you think that could happen here? So, do you think?
The short answer is yes.
Me too.
The short answer, if I was to put $1 on, if I'm wrong with the way the markets are looking, it'll be not that the rate cut's going to be pushed out to 2026 or something. It'll be we'll see 4 or 5 rate cuts in the next 12 months.
Yeah, okay.
I think, and this is where the issues for me on the labour market are so important. Inflation might be sticky and the Fed in the US might delay their first cut. But I look around the world and I hear business people that I speak to, and they're saying it's pretty crook. Things are pretty grim. And it might not be showing up in the hard data because, of course, as we're saying, the GDP numbers we got just the other day were March quarter, January, February, March, and here we are in the middle of June almost. So what's happening now? And, of course, you adjust interest rates, it doesn't impact the economy for 6, 12, 18 months. So if I'm wrong, there'll be a lot more cuts.
When did the June GDP numbers come out?
They come out in early September.
Oh, my God.
So it's the footy finals will be on.
Yeah. The Roosters will be in the grand final. Okay, Kookie, thanks very much, mate.
We won't talk about South, but thanks, Mark.
Hey, Kookie, I know this is a really urgent call out to you. I mean, we're going to do this through FaceTime, but we did our recording for our 18th of June Reserve Bank decision. We've done that already. But this is like an addendum because something came out through the ABS straight after we did a recording, literally the next day. And it's something you and I have been banging on for about a long time, but it was the unemployment number actually did not rise above 4.1, which is where it has been for a couple of months, but actually fell to 4. Now, that sort of concerns me a little bit, only because I'd love to know that everybody in Australia is fully employed. I love that whole idea, and you and I keep talking about the new direction of the RBA around full employment as a result of the review that was done last year by the Jim Chalmers Treasury imprimatur. Yep. But if unemployment has fallen, that sort of tends to indicate to me a couple of things. And I'd like your opinion on this, please. Has the RBA changed its view on what full employment via unemployment looks like? In other words, has it gone back from 4.5 to some other number? Or, mate, does it mean that if they have stayed where they are and they are still at 4.5 or some other number close to that, that this 4% number means we are in for a long, long period of time whereby these high interest rates will be maintained?
I think you've summarised the debate in a minute there. You did a great job, because I think the critical issue right now, with those unemployment numbers that we saw yesterday, 4.0%. So, as you said, for the last, 5 or 6 months, we've been 3.9, 4.1, 4.1. We've been 4% basically if you cut out that monthly volatility. That's really important thing to acknowledge, that it hasn't gone to 4.5 or above, which you would normally expect when your economy is coming down. As we spoke about the other day, GDP growth 0.1% in the March quarter. We should be seeing firms shedding their labour, sacking people in other words, and the unemployment rate should be kicking up. They're not. Which goes to your point about the RBA. They meet next week, they're going to be considering interest rates, and while no one's expecting a move, if they are wrong with their assessment on where full employment is, and the unemployment rate that reflects full employment is 4%, not 4.5, which I think is in the public record, it might be a fraction lower in recent times, then it means that monetary policy can be eased a little earlier than the market's pricing in. And I'll say one other thing which sort of validates that. You know, we look at the wage numbers, you know, because if you do have a tight labour market, if the unemployment rate is too low, wages pick up because there's a shortage of workers, everyone bids up wages. Fine, we know that. That's what 100 years of history tells us. The last 3 quarterly wage numbers that have come out, we had 1.2% in the September quarter last year. It slowed to 1% in the December quarter last year. March quarter numbers, which came out a few weeks ago, 0.8. So, you know, if a 4% unemployment rate, which is what we have, was a tight labour market, was over full employment, you get wages picking up. They're coming down. And I think that, what do we call it, juxtaposition, is telling us that the RBA might have got it wrong on full employment, unemployment rate, NAIRU. If that's the case, then when the penny drops for them, well, certainly there's no rate hikes, but does it accelerate the rate cutting cycle? This is sort of more a medium term thing, but it is an important thing.
Yeah, but, and so in other words, if I can put it into my words so I can make sure, and you can tell me if I'm right or wrong here. In other words, given that wage rises, national wage index increases, is actually increasing at a decreasing rate.
Yep.
In other words, over the past period, like let's say the last 6 months, that those increases in the national wage index is coming down, and it's right now is at 0.8%.
Yep.
Given that is the case, and given that unemployment seems to be, let's call it sticky, around 4% for the last period, for the same period, that would sort of indicate that maybe there needs to be a review on the non-accelerating inflation rate of unemployment from 4.5 to some other number, and maybe the RBA will do remodel, maybe. And when they do the remodeling, they might say, well, you know what, we're in a pretty good spot here.
Yeah.
And maybe we've got to start to consider that we don't need to keep interest rates up high for much, much more longer, because we are in that, at least at the full employment level, that unemployment piece, we're actually at the sweet spot in regards to that. The only fly in the ointment, of course, is inflation.
That inflation fly, correct. But that analysis of the unemployment rate and the RBA's thinking about it is very, very true. That's a problem with economic models, because you need the data to confirm this change in theory. So for the Reserve Bank, our friends at the Reserve Bank, if we have had a change in what the estimate of the unemployment rate when full employment's reached, and the RBA realised that, it has big implications, because we're getting wages growth decelerating with an unemployment rate at 4%, not 4.5%. So the fact that we're there already has implications, because wages are a component of inflation. Everybody knows that. So when wages go up, if you're a business person, you want to maintain your margins, you sort of bump on a couple of percent, and normally that's 2 and 3%. That's the inflation target of the RBA. So if the fact that you've got wages decelerating right now with unemployment at 4.0, not 4.5, means that the RBA could be shocked in the next quarter or two about how low the inflation rate comes, that we've got this deceleration surprisingly coming through. And if that's the case, then the market pricing could easily revert back to pricing in a whole lot of rate cuts. And it's as simple as that. So in a sense, what we are looking at now as economists, and I know the Reserve Bank up at Martin Place, or they've moved while their building's being renovated, but what they're looking at right now is whether that correlation can hold, whether we can sort of live with a 4% unemployment rate. And that's a good thing. You know, as you said, Mark, I want every Australian to have a job, to work, earn money, you know, have a better living standard. You know, that's what economics is about. And the difference between 4 and 4.5% unemployment rate is about 100,000 people.
Yeah.
100,000 people. So it's not just a decimal point that we're arguing about on unemployment rate. It's people that matter.
You know, and so final piece to all this is that when the media says, oh, careful, unemployment's only at 4%, it's dropped from 4.1 to 4%,
Yep.
and this is a problem. Actual fact, given the new emphasis on full employment via unemployment today, given the new emphasis on that, I actually think a 4% unemployment number with decelerating wage index is good news, because we may settle at 4% unemployment, and that would sort of indicate, because wages are decelerating, that there is less pressure on pricing, which means, should mean over the long term, or the medium term, I should say, means less pressure on inflation, which means we might be happy enough, or the Reserve Bank might actually take a different view. As you just said, they might start considering interest rate reductions. But what's interesting about all this is the money market is not taking this stuff into account.
Not yet. And I might just say one other thing which might be explaining this. So why did the RBA get it wrong? Because when the RBA makes a mistake, it's always interesting to think about why it got it wrong. We've spoken about high immigration as its impact on housing, on the rental market, house pricing. You know, and that's pretty obvious. I think that's obvious. But also, when this 500,000 people who have come to Australia in the last 12 months arrive here, they want a job. They are supplying their labour to businesses who want to employ more people. So therefore, the business that wants to hire a builder, a sparky, a retail worker, whatever it is, they can find them without having to bump up wages. So you've got a supply of extra workers at a time when the economy's weakening. We know that. So I'm wondering whether the immigration intake, while it's creating some issues for housing, no question, is actually got the silver lining, every cloud's got a silver lining, of supplying labour, allowing this wage pressure to come off, because there was arguably a bit of wage pressure 12 months ago, 9 months ago. Whether it's creating an easing in labour market conditions, the skill shortages are being addressed, and lo and behold, when we get the next, 1 or 2 quarters of data, wages are still under control. Oh, gee, inflation's surprisingly low. Oh, our friends in America have cut rates, so have the Canadians and the Europeans and the British will be part of that story. That's where I see the risks going forward, that we're going to be not seeing rate hikes. I think I can rule that out. I'm pretty confident. But we'll be talking more and more about an earlier and more aggressive rate cutting cycle than's currently priced in.
Well, isn't it amazing, as I look at the big apple sitting over your right shoulder,
Oh, yeah.
but isn't it amazing, markets for interest rates, unemployment, inflation, etc., always find their own spot, and the modelling is just that, modelling. We might all end up at 4% unemployment and 2.8% inflation, and therefore the cash rate will come back into where it needs to be, settle into a nicer spot, which might be instead of 4.35 might be 4.35 or something like that. Over time, we're not talking about it, but not immediately, but over time. Isn't it amazing how markets make their decisions? And I don't mean individuals in markets, I mean markets themselves. They're pretty perfect. They make the decisions themselves, and all the modelling that we do and all the modelling everybody keeps talking to us about all ends up to naught. And the thing we get nervous about.
And at the end of the day, and the markets react to news, the weight of money in markets, it reacts to this sort of news, and this discussion that we're having, I am sure, is happening in the dealing rooms of the big hedge funds. And
no, they're listening to us, mate. They're listening to us. The money market's going to change Friday afternoon as a result of what you and I are talking about.
Just by the way, I'm looking at the markets. I've got my other screen here. We do have a rate cut now being repriced into our market. A month ago we had hikes being priced in. I'm looking at my screens now. We've got a rate cut in the first quarter of next year, and another one by the end of next year. I think that's the bare minimum. They'll be brought forward and they'll be a little bit deeper when I think the dust settles on this full employment, wages, inflation discussion.
Well, they've obviously been tuning into the Kooky Bouris show, and away we go, mate. Good to talk to you. We're gonna stick this on to our last podcast just as an addendum because I think it's important, mate.
Important. Thank you, Mark. Always an absolute delight to chat.
See you, mate.
See you.